Hi, it's April 22nd, Friday. You know what, I'm just writing an article for Global Executive. I don't know how many people out there follow them, but they must be pretty smart because they like me and feature me a lot. And the name of this article is, what's the most important number in the world? Okay? And you know, there's all types of global population pushing 8 trillion, billion, going towards 11, and GDP at 94, 95 trillion here recently and stuff. No, the most important number in my count, and especially right now, $550 trillion, my estimate, put together from very good statistics, of global financial assets. Why is that important? Hey, GDP goes down so many percent in a recession or a stock crash. Financial assets can go down 80 to 90% for stocks, 40 to 50% for real estate. And we've seen this in our lifetimes, in our parents' lifetimes before that. The 29 to 32 crash in stocks was 89%. The last real estate downturn was 34%. I'm projecting this one will be 40, maybe 50%, okay? $550 trillion. Now, if that comes back down to reality, and reality is, for example, a great example in the US, financial assets from 1950 up to 1995, before the stock market started bubbling, that 95 to 2000 bubble, and then bubbles ever since, and real estate to follow. That 3.2 times GDP, okay? And now it's 6.4. Just to fall back down to that 3.2 average, that's not like the worst of times, just the average, would be $77 trillion in financial assets disappear just in the United States. But that global number, 550, 225 trillion could disappear. And, they will come back, but slowly at first, and in peaking regions like Europe, especially in North America, increasingly, they may never get back to these levels or take much longer. And most of the growth will be in Asia, where most of us are not. So this is a really big deal. And in my Harry's Take on Tuesday, I put out the most important chart I've seen in a while. And it shows the rates on 10-year treasury bonds, okay, the risk-free treasury bonds. And they tend to go up in booms and then go down into downturns. And in fact, I keep telling everybody, it's not gold, it's a safe haven. It is long-term 30-year, 10-year treasury bonds. It's TLT, ETFs, Z-RODs, it's things like that, okay? But that chart showed a 40-year chart of T-bonds spiking in booms and then going down. And every time they've gone down more. So it's only a straight line at the top. It's a crescendoing line on the bottom, okay? So that line hits at 2.81%, I showed on Tuesday. Well, we're at 2.96% this morning, last I looked, okay? That's what I call a throw over. If you look at all my newsletters and all my past stuff, when we're in a channel or any kind of long-term trend, over many years or decades, you tend to get a throw over rally at the end of the trend, at the top of the channel or the triangle or whatever we're in. So that's what I call this. 2.81% is the top 40-year top. So it's going to be very hard for treasury bond yields to go above this. And it's a declining line because inflation has been falling since 1980-81, as my inflation indicator, which I innovated in 1989 for the first time, has so accurately forecast and continues to see inflation being low and then turn up slowly from 2024 forward, okay? So this is what's important. I think this is a throw over. We might get to 3% or a little over, so I'm watching this very closely. We're breaking this, but this looks like a final kind of signal. And again, in a long-term trend, the markets will always try to fake like they're going to a new channel or a new higher trend before they collapse. So I do think this is a peak. And so I'm going to be giving subscribers, continuous updates as usual on this. This is the most important thing I'm watching. This says rates should go to 0 or below, and that's going to mean 40, 50, 60% gains in one of the safest investments, not the most risky like U.S. stocks or gold or anything else, and commodities, the safest investment on earth, long term treasury bonds. So there's two ways to make money in this downturn, which especially if this trend does reverse, we need to go back below this 2.81% level and keep falling to say, okay, now we're heading down in yields. The bonds are going to sense a downturn before stocks, okay? So this is an important indicator. Then we're going to see this monumental crash. And there's two things to do. You can be long these highest quality treasury bonds, AAA corporate if you have to, if that's your only option in some plan you have, or the highest grade corporate bonds. But the 10 and 30-year treasury, especially 30, TLT is the best ETF and most liquid. ZROS, 25-year instead of 20-year average, more leveraged, less liquid. So you know, you might want to buy ZROS for your core position and then TLT if you're going to move in and out because it's more liquid. But that's the place to be. Long, the safest U.S. Treasury bonds, and short stocks. If you're aggressive, you can short the stock market, and stocks will go down 80 to 90% in major indices, if I'm right about this being the first 90-year Great Depression and financial asset reset since 1929 to 32, okay? Stocks will go down 80, 90% or even more, but bonds like this, which are much safer, and will go down 40, 50, even 60%. I'm sorry, go up, okay? So that's the play here. And I prefer the bonds first, then we see more proof that we're moving into this next crash, which I think should happen soon. We should see the first more noticeable crash, and the market did not do that. Remember, I've been telling everybody, the best sign that a bubble's over when you see a 28 to 50% crash, average 41% in the first 2 to 3 months. Well, that first crash was 22% on the NASDAQ, 14% of the S&P in the first couple of months into March from January peak. Not clear that was a top. It still could be, okay? But that's not what typically happens. So we could still make a new high on the S&P. So I'd rather lead with the bonds here. They are at an important trend line, and then follow with shorting stocks for people who want to take more risks. So again, very, very important time here, and I will keep you updated, of course.